Our first speaker is Jim Hansen, who comes to us from Seattle. Jim is a financial planner who has been an independent planner for 25 years. So he's seen a lot of ups and downs. He is an ASPO member as well, so he does definitely believe in the message of this conference. He has a BA from the University of Washington. If you would join me in welcoming Jim Hansen.
Well, thank you. I have a voice that carries pretty well, so if I blow anybody's ears out, let me know. I'm not real good with microphones. If you were here on Wednesday morning, you're going to get a second dose. So some folks have asked me to go through those slides again. So now I'm assuming I just push the green button. Okay, we push it again. Nothing happens when you do the green button? Oh, I'm seeing it on here, but you're not seeing it up there. Okay, there we go. Okay, this is the one, well, that's fine. We'll back up. Okay. You've got the first one. I mean, excuse me, you got the second one. Do you have the other? Can you get that one up? That's the one from, no, I want the one from yeah. I'll run over that first. Partly because Leslie likes my Ski Dubai picture. That one, yeah. Those of you there, you know, you also got to see the trauma of dealing with Microsoft software. Okay, let's go through, and then of course there's the obligatory, come on. I'm getting tired of looking at my name. Am I doing something wrong? There we go. Okay, everybody read that? Good. Now, there's two pictures up there. The one on the left, by now, a lot of you probably know that is the Thunder Horse rig. And the amount of money that's been poured into that means that we're not going to see, we'll never see $45 oil again. If we get to $45 oil, they'll just come out and pop the cocks open on that and then drain it to the bottom, and it'll be the end of that project. It's just history. So we won't get any oil out of the ground if we don't get the price up. So, and as Charlie indicated, any company that's planning on that price, I think is definitely off the curve. The one on the right, though, I think is probably even more significant, especially if you take into account Jeffrey Brown's work on net export. How many people know where that picture is on the right there? If you've been to, this is what those desperate housewives will be doing in Dubai, by the way, and that is skiing. That is the indoor facility, and I understand they're now in the process of building a larger one that has a double diamond category chairlift in it, and it's 110 degrees outside the day that picture was taken. That is why the net export capacity of the Middle East is going to decline, and decline at a rate in which the markets don't understand. Those people, anybody, I mean, well, it speaks for itself. I take the position that energy, given the 90% return that you make from the decision of your asset class, this is from the California Retirement Plans investment policy statement. If the asset class selection accounts for 90% of your return, but most people spend 90% of their time trying to find the best stock, it accounts for about 10% of a large or reasonably diversified portfolio. So traditional asset classes then, cash, bonds, stocks, real estate, and maybe precious metals. I'm suggesting that you add energy, and it's more than just oil. But as you get more into peak oil, you realize that this thing broadens out to nearly cover the entire, well, it's everything we do. It permeates your lives. So add that as an asset class, and then you start to move forward. So, you know, here we go. This is, you're going to get out to see Microsoft's fine performance. These are the 5- and 10-year numbers for the asset classes. And these are based on Vanguard's no-load funds. All the data was available, and most people are familiar with them. There's their energy fund. Energy fund, by the way, is replicated on this ETF as the VDE. And there's your more or less traditional diversified kind of portfolio you would have. And now comes the interesting part. It overlaps. The bottom line is if you add the ETF or the energy index in there, reweight, and only to 15%, by the way, and which is only, you know, kind of on the low end of what Charlie was talking about, and it is definitely on the low end of what I'm doing. You're adding about 2% to your return. Now, ETFs, I know a lot of you are probably individual stocks folks, but some of you might be into using ETFs as vehicles simply because their simplicity. And if you're purely asset allocating, of course, they're a great vehicle. I will warn you, though, that be very careful with ETFs because the process of creation and destruction of those is not well understood in illiquid markets. And there will be, I guarantee, some bad stories come out of the ETF market, particularly in the very, very small illiquid markets that are being done, say in biotech, where they've dissected it down to maybe 20 or 30 stocks in the sector, and they've got an ETF that's holding half of them. This is the holdings as of the 10th of October of the IXC. This is a global, and you will notice the dominant position in one of those liquidating companies. By the way, I want to thank the folks at Shell. It was their disaster in the fall and winter of 2003 when they wrote down their assets that brought me to peak oil. That was the first rock I turned over, had a cockroach under it, and had peak oil written on the back of it, and I didn't know what the word peak, what that meant, and it led me to here and has resulted in some nice returns. And you get down to Schlumberger and then BG Group natural gas. But the key is that it represents 61% of your holdings if you buy that index. You're just in the top 10, and it's all the majors for the most part. Now, if you buy, to make matters even worse, if you were to buy the iShares versions of the US ETFs, you will have 44% if you buy the IYE, which is another ETF that trades, it's a US one. There are no non-US oil companies in it. 44% is in 3 stocks, ExxonMobil, Chevron, and ConocoPhillips. So if you buy what Charlie said, what I'm going to say, and I know a number of others here, that the majors are probably not where you want to have the majority of your money, that ETF might be a mistake. The XLE, which is another very popular energy ETF, is 43% in those 3 stocks. And the VDE, which is the Vanguard and is, again, very, very popular, is 39% in, again, ExxonMobil, Chevron, and ConocoPhillips. What's fascinating is that they have no coal. 52% of the electricity in this country, roughly 52% is electrical generation is coal. No nuclear exposure, and no renewables. Now we'll take a look at the AIM fund. They're based here in Houston. They're actually one of the better performing open-ended funds that you can buy. Here's their portfolio mix, and again, I apologize. This was done under Office 2007. There's a compatibility problem with 2003, even if you use the conversion software they provide you with. So when we now take a look here, you'll notice the mix is different. 38% is represented by the top 10, but you don't have a 17% exposure to ExxonMobil. They've definitely outperformed the kind of more or less traditional portfolio. My point here now is that, and again, I wait here. Again, no coal, no nuclear, and no renewables. And I met with them the morning before the first day at the conference here, and they had Peabody in their portfolio, but they took it out, I think probably incorrectly. And they had Cameco, and they also removed it as well. But there was very small, 3-4% exposure for each. So if you're buying a mutual fund like that and you think you own the energy universe, you're making a fundamental mistake. So, and then again, what I mentioned the other day, can energy investing save you? I would say for most people, probably not. Here's an example. If you drive 50 miles a day and you get the average 20 miles per gallon of the average car in the United States, 14,400 miles a year, fuel at $3 a gallon, annual cost $2,160. So how much ExxonMobil stock? Again, most people, when you mention energy to them, they think the gas tank, which immediately leads to ExxonMobil, which their thinking is. So it's probably going to take more than you think. We'll take about $169,000 at ExxonMobil's current yield of 1.5%. Gives you a gross yield of about $2,500 a year. You get the dividend tax rate. You're left with your $2,160. The next key question is, will the dividends even rise fast enough in the future to keep up with the price rise? Historically, no. The average 401k balance in this country is $54,000. If you're planning on your investments, and most people's retirement money, to help them through this energy problem, they got a problem. No, they don't have a problem. They're way beyond problem. And that's just fueling your car. You got to turn the lights on. So where I've gone with this is put most of your effort into looking at your energy footprint of your lifestyle. If you're fortunate enough to have the 10,000 square foot house on the hill with heating and air conditioning issues, you might want to step back and take a serious look at that going forward. Because that will be, the impact of that decision will be far more important than the impact of what you do with your investments. The energy minister from New Zealand made this comment last year, about almost exactly a year ago. And I think it's important because the timing of this whole thing within the context of people's lives and the mitigation times involved based on Bob Hirsch's work, it's a moot point. It's irrelevant. However, as a U.S. consumer buying a product priced in dollars from a customer who's going to get concerned about the pricing in dollars, you need to take it. It's going to affect us before we hit it, and we're seeing that now. So keep that in mind. Your lifestyle, the energy footprint you have is where the real bang for your knowledge of peak oil and gas will help you. Now, friend, this is interesting. The next thing comes up on the slide here got more questions than anything else I've said the whole week. Apparently there were two Boeing guys in the audience when I said this. They never came up to me. I'm ignoring the whole issue of whether there's enough composite fiber out there to even meet the needs of building the planes. That's another issue completely. I say this somewhat to get attention, but after listening to Roger's presentation, I've decided that I now need to underline it because I think I may be more on the mark than I realized. It's not that they won't sell planes and ship some of them, but there's a good chance that the majority of their customers won't be around to complete the order. That's my point. I think you need to look at this very, very carefully. If you are running a business that's highly globalized, or if you are investing in a business that's highly globalized, you are dependent upon incredibly cheap energy. Artificially cheap, I mean, in terms of man hours, labor, it's free. At 400 man hours per gallon, that's free. And then the other is if you are dependent on a just-in-time inventory management system with a long supply chain really dependent upon, say, FedEx or UPS or very, very low transportation costs, you could have a fundamental business model flaw. So the question that you always need to ask on any investment you look at, I don't care if it's photovoltaics, you better make sure the energy intensity of that business is acceptable. And is not, that may be the weak link in their entire model. U.S. Postal Service, maybe. Okay, now if you can put the other one in, I'll hit through that real quick. While we're doing that, I want to encourage all of you, if you've not seen Jeff Rubin's presentation that he gave earlier this fall, he's from CIBC in Canada. They get it, or at least he gets it. His PDFs of his slides are available on the internet. You can go to the Oil Drum, they've got links to it. But his video from his interview on CNBC is fascinating. There was one remark in there that just about blew me off the chair when I saw it. I couldn't believe they did. Mark Haines was interviewing him, and he had been talking about the situation in Mexico and the implications and talking about the gas situation up in Canada and the critical nature that it was moving to. And during the whole interview, Haines is kind of staring at the ceiling. He's kind of, it shows you intensity now. And finally, he says, well, we could just invade Canada, can't we? So I had that in a report that I mail out each week. And I started getting a flood of emails back from the folks who get it in Canada. And it turns out they think that. I mean, maybe they're giving me a little cheeky with me, but the point is, I'm not sure it's that far from their minds. After all, there is some history that happens. So I would encourage you to look up Jeff Rubin's work. His PDF of his slides, particularly the one on Mexico, and the potential implication that they could be a non-exporter by the end of Calderon's current term in office is huge. And the question I always get asked is, how big a fence are we going to build? Interesting question is that I get asked, well, the price is going to give us a warning, isn't it? And I've kind of lifted this from Matt Simmons a little bit here. But the point is, in the late 60s, we were paying $1.35 a barrel for oil. Look at what we were paying by the end of the 70s at $17.50, and in any time during that decade, at $1.35 a barrel, I wouldn't have called that a price signal. So I wouldn't interpret what's going on in the market today as a price signal either, as to the scarcity of the commodity. World economy suffered stagflation. You start to look at the events that are unfolding in front of us, we could be here again. I'm not predicting it, I'm suggesting. Consider these situations. Oil climbed from world consumption from 49.4 million barrels in 1971 to 65.5 by 1979. The key point, though, is keep in mind it did decline from there. Okay, we had the recession, but it rose 13-fold, and demand grew by 1/3. Now, when you tell most people who lived through the 1970s oil embargoes, they would have never guessed that. When I give public presentations on this, nobody ever gets that. Nobody ever predicts that that was the case. So where did the demand, now I want to go to the next era that comes right behind it, because this is important, I think, in that the era from 1977 to 1983 is when all the apparent demand destruction occurred from the big price spikes that we had endured through the 70s. And then we had the big recession that was driven by the higher interest rates. So in 1978, petroleum consumption in the United States was 18.9 million barrels. We go down in 1983, it bottomed out at 15.2, and it took us 15 years to get back essentially to the 18 million barrel a day. So where'd that demand destruction come from? Well, it really, I don't think, was as much demand destruction as most economists and investment folks give it. In 1977, we had 17% of our electricity was generated from petroleum, mostly residual heavy fuels and diesel. In 6 years, it was pushed to single digits. Now, there's a scale reason why that was able to be done, and I'll come back to that. By 1998, it dropped to 2.5%, and today it's even lower. Now we look at home heating. Now, if you live up in Maine, you're probably still using home heating oil. 1977, it was 32%. Essentially, 1/3 of all homes in the United States were heated with heating oil. By 1998, it was down to 17%. It continues to fall. So the question then is, did we really have demand destruction? So I want to look now at a chart. This is from the EIA. The circles are when periods of recession. The large circle being the big recession in the early 80s, the 1990 recession in the middle circles, and the what I guess you have to call the superb internet market performance post-2000 in the circles on the right. Now you see, it shows us a very large decline in demand in the early 80s in that large circle. Oh, by the way, the black line represents transportation's component of our consumption. And it's important because that relationship continues to escalate. So transportation will be the sensitive indicator on the demand side. So look at the large circle and then look at the smaller one right below it. The large one represents the total, and the one at the bottom is your transportation fuel component of it. Notice there is a big difference in the steepness of the decline. And the reason, of course, is buried in the residuals and generating fuels that resulted in those declines we saw in the previous chart. But look what's happening to the decline due to economic slowing in the next 2 recessions. It's diminishing. It's becoming increasingly inelastic. I think most people who are looking at current prices at $90 a barrel are looking at the 1980s experience. They're going to miss it. And we are going to go to prices that no one expects, because that transportation component, look at the last one, it barely shows on the graph. So I think there's a good chance that going forward into our next bout of price and economic downturn, we might be surprised. As we climb out on the demand limb, we're going to go further out before it gets cut off the tree. That's my non-economist view. I think we have to take a non-traditional approach to this because the world has changed. Now here's another one. I want to make a point that you can argue that the issues facing us today in this market will be the same even if peak oil doesn't occur. Humanity's ability to bring demand on the scene exceeds humanity's ability to bring forth supply. As it gets more and more constrained, harder to find, as Charlie says, you're going to go to deeper and deeper water. You're in 8,000 or 9,000 feet of water. It's not the same as drilling in Oklahoma. So you look at these numbers. You use the earlier in the year the IEA's estimates, or the IEA estimates for 86 million barrels. You put 2.5% on that, and you've got all of the export capacity of Kuwait. So we got to find another Kuwait next year. Or you're at 85% of number 3 Norway's exports. See, I don't use production. I don't care what production is. You got production on the moon. I can't get it. It might as well not exist. So those export numbers. I mean, Jeffrey Brown, I think, you can take his work and you can carry it off in many, many directions. And again, he doesn't have to be 100% right until it impacts you dramatically. It's the same demand as throwing another Brazil at us in the world. And remember, that's 1 year. You got to do it again next year. Remember I said that line about the Boeing 787. After listening to Roger's talk, I'm not recommending you short Boeing, but I think it's a great indicator of the most important point that he made, and I think most of us missed it. It wasn't about the airlines. It was the GDP decline. That was the most important point in his presentation, because it's going to affect a whole lot more than just airlines. And then he made a great comment about the bonds. But I wanted to go to the next logical step. Most municipalities finance their roads with gas taxes. And in almost every case, they're based upon a per gallon tax. If we really do get some demand destruction, if we really do get conservation, the irony is the revenue expectations they have in place will not occur. So if you're an individual bond buyer, you might want to tuck those little details in the back of your head and keep them in mind as you're looking at it. And I think that applies to any of those that are unit-based rather than dollar-based, because they're not going to inflation adjust either. So I guess I should have asked that question about that Dreamliner again. And then my last is, most of us are leveraged to energy to a degree we do not know. And many of us are leveraged in the commodities market. And this again, I'm kind of going out on the edge here maybe a little bit, but if you got a 30-year mortgage and you're 40 miles from home, you got a 5-year car loan on a 10 mile per gallon SUV, you are leveraged to the commodity market. You didn't know you were playing in the commodity market. You have built a lifestyle dependent upon a subsidy of cheap oil. And the infrastructure that supports that cheap oil is not going to shift to an alternative fast enough for you to bail your tail out. Remember also that the speed with which we live our lives is dependent upon that cheap energy. Do we really need overnight delivery? Now, I can get the CD 2 days later, it'd come by Pony Express maybe or something else. I mean, speed is a component that will probably come out of our economy. So if your business is based on speed, you better take a good look at that. That may be a very vulnerable component. So, or if one of your critical suppliers is. On that note, I want to thank you, and I do have a few other things. I want to mention one other thing. First of all, the fellows like Jim, sitting over here, first time I talked to him, I thought, I had this image of what Jim looked like. And this isn't the image. I had a guy sitting there with an oil well next to him. No. I'll tell you, guys like him will, I think, go down in history with a much bigger profile going forward. See, guys like Steve and the ASPO people, 100 years from now, they're going to look back and they're going to They're the guys who the society is going to look back and say they should have gotten a certain award that was given out last week.
Thanks, Jim. Our next speaker is going to be Dick Vodra. Dick is a member also of ASPO, and he runs a company called Spire Investment Partners in McLean, Virginia. He's a certified financial planner, graduate of Yale Law School, and has written some articles about peak oil in various financial planning magazines. Please welcome Dick Vodra.
Thank you for having the endurance to remain with us. I think this is an important topic because one of the challenges of a conference like this is, okay, we get it, now what do we do with it? And hopefully that's what a lot of this morning's program, all three of this morning's workshops are dealing with, and we're happy from our ego standpoint that you chose to sit with us instead of the people upstairs. But so I look at peak oil, global climate change, and the planner's response because I think that global climate change is as urgent a problem as peak oil. I think they are both aspects of energy. I think they are on basically the same time frame based on the things we've been reading about lately on the Arctic Ocean and the fact that, well, there was a great article, I don't know if you happened to notice it, because it was hiding on the front page about peak oil on the front page of the USA Today that was given to all of us yesterday about we see the problem, but we're hoping something's going to happen with it, except it was actually describing the drought in Atlanta. And they're down to 2 months of water, and they say, well, we don't really have a plan B yet because we're hoping for rain. And, you know, this is a pretty good summary of, I think, how we're approaching peak oil as well. So I'm thinking that, you know, how do you apply financial planning principles to peak oil? And as a planner, one of the things that I'm often asked is, do you tell your clients about this, and why are you still alive? How do you present this in positive or at least less depressing ways to clients? And how would we plan for clients who have comparable problems? How do we plan for clients who have medical issues or who have parents with Alzheimer's or you know, there are a lot of people who come to us as planners who have serious long-term problems that are foreseeable. They're working in an industry that's dying or they just lost their job. So there are two kinds of responses. One of them is investment-based decisions, the kind of thing that the two previous speakers have given you. The other are life decisions. And I think that life decisions, as Jim was saying at the end, you know, the investment implications of where you live, you know, and what kind of car you drive are very important financial decisions, just as important as whether you should buy Halliburton or Schlumberger. So one of my theories or beliefs is that peak oil and climate change are going to cause disruption and new rules at all levels. I think that what we found is that there's going to be a great disruption, great discontinuity coming sometime between tomorrow morning and 2012, or sometime between last week and 2012, and that what the world looks like after that, we don't know. I'm thinking of someone who was sitting in New York City in 1930, asked to predict what the world would look like 5 years hence, and someone who was sitting in Berlin in 1930, asking to predict what would happen 5 years hence. The situations they faced were very similar. You know, world power centers, financial centers, chaos on the streets. One of those people got Hitler, the other got FDR. And it could have gone the other way in both places. So we don't know what's going to happen around the corner. So the question is, how do we prepare? One of them is to reduce risk exposure generally. Get out of debt, you know, try to have things that have some durable value to them. We're going to have a world in which energy is more expensive, less reliable, and less available. Imagine a world, imagine operating America with 23 hours of electricity a day. You know, I'm not going to be very happy if I, you know, trying to get up to my 10th floor room in this hotel. But a lot of the world now lives that way. And with the grid being pressured, by the prospect of plug-in vehicles and constraints on energy, what do? So you reduce your energy and carbon footprint, downsize, live close to your family, live close to work, take your vacation now. Don't wait for the 787 to be delivered because it may be unaffordable by then. Transportation is going to be much more expensive and agriculture will be very affected. So look at localization, the kind of thing that Julian Darley's talking about here in the Post-Carbon Institute. Farmers markets and know your neighbors. Figure out, we don't all have to drive to Costco. We can carpool. We don't all have to have a 12-foot ladder in our garage. We can share. These are new concepts for America that we haven't heard of, for 50 years, but we're fairly familiar with them before. Staying healthy and learning new skills will be very important because if we don't have the number of energy slaves in the future that we've been used to, then we're going to have to do more ourselves. And becoming and staying healthy is going to be very valuable. Medical costs are going to continue to go up, and so the less you consume of medicine and medical care, the better off you will be. But we also have money to invest, and typically when you look at investment policy statements, the kind of thing that Jim referred to from the California retirement plan and the thing that all of you should have, it's typically points 1 and 3. Define what the money's for, what's your goal, what are your risk limits, and so on, and describe, therefore, your investment process and how you're going to allocate assets. But what most people don't do is define the worldview and the investment assumptions. Is the 20th century record still relevant, or are we going to have different rules going forward? And I think we will. So I've adopted what I call a Worldview 2 portfolio, one which takes climate and peak oil seriously. Some of the aspects of that are that the dollar will continue to be weak, I believe, because we need to import an awful lot of things and we don't have corresponding exports to get them. There will be a relative price rise for energy and commodities, a relative price drop for other things. I think we have major risks of both inflation and deflation. I don't know, again, what's going to be around the corner. There are deflationary pressures if we have economic decline. We don't know how to operate. We see the Japanese example of what happened with 2 decades of deflation, and we may go back to stagflation simply because we feel better. It felt like the United States stock market hit a record high this last week at over 14,300. If you're in euros, that's 10,000 euros. You didn't make any money for 3 years, but Americans feel good about it. So I think that there's major risks of major declines or slow growth. So what might a Worldview 2 portfolio look like in an asset class sense? It's fairly conservative and radically different than what you probably would have had 5 or 10 years ago. 10% in U.S. cash and 10% in non-U.S. cash. 10% in inflation-adjusted bonds, 10% in foreign bonds. So we basically have no traditional U.S. bonds. We have 10% in commodities, either indexes or direct holdings. That might include precious metals. 20% in energy and natural resources. 25% in sort of general common stocks. The world is not going to end the day after tomorrow. So I think that, we will transition into a world and there will still be general investment opportunities, and 5% in real estate. I think we'll have more direct investments and putting more money into the changes in the way we live. So rather than holding $169,000 in Exxon so that you can pay for your gasoline, buy a more efficient car and drive less. Instead of assuming that your investments will spin off enough income to live on, figure out how to reduce the need for income by insulating your house, growing food, and that sort of thing. So cutting down the demand side, we've been talking about demand destruction. We can find demand destruction without destroying the values that we have in terms of what's important, what we say is important in our lives. People in the 1950s were just as happy or miserable as the people today. They just spent less money doing it. So there's we've had the first part of the conversation was about, what stocks should we buy? And there's a new website, relatively new website called energytechstocks.com. I think it went live around Labor Day. And they have kind of a busy front page here, but On the left, they've got a list of some funds, publicly traded funds in energy world, both ETFs and general mutual funds, actively managed funds. And then they have their ETS stocks list, which lists all the publicly traded stocks they can find in sort of the energy and particularly alternative energy field. Now, unfortunately, this is a screen that you have to scroll down, and it's kind of hard to scroll down on the, so this is their list of stocks. Pick the 4 that are going to win. This is an amazing, this is the universe of battery companies, solar companies, wind companies, distribution companies, and so on that we're operating in. And I'm not sure that any of these make good sense, because if you go back to the 1840s, the dominant new breakthrough technology in America was canals. That prior to the 1840s, if you wanted to get goods from Pittsburgh to Baltimore, you went via New Orleans, because it was the only way you could move things was by water. If you had invested in every publicly available canal company in the 1840s, you would have lost all your money. By 1875, the breakthrough technology was railroads. If you had bought every publicly traded railroad in 1875, you would have lost all your money. By 1920, the breakthrough technology was automobiles. If you had bought every publicly traded automobile company in 1920, you would have lost all your money. By 1980, the personal computer people were seeing that was something to come. If you had bought every publicly traded personal computer company in 1980, you would have lost all your money. Warren Buffett famously has said that some good investor should have gone down to Kitty Hawk in 1903 and shot down the original Wright Flyer, because the total return of the U.S. airline industry since then has been negative. Figure out what internet companies you should have bought in 1998 and how sad you would have been if you had actually bought all of them. So in 2007, even if you understand the technology and that this is what's coming, the odds that any of these are going to turn out, or which ones of these are going to turn out to be the survivors, is not terribly good. So that's why I don't recommend individual stocks to my clients, and I will be happy to defer any questions you have and to other people who might want to. But when we're talking about investing in the peak oil world, it's not just energy companies. I mean, we're at an energy conference, so what about this company or that company, and the majors and the service companies and so on, but it's also agriculture. How are we going to remake American agriculture? Where are the efficiency operations that are going to happen? How are we going to remake transportation when we don't have transportation fuels? How do we retrofit buildings? We have an electric car out there. What's the grid? How do we rebuild the grid to get the windmill power from North Dakota to the users in Pennsylvania? So there are a lot of opportunities, and I would urge you not to be narrow-minded in terms of where you're looking for investment opportunities. And two other final points, or a few final points here anyway. One of them is the question that we always need to ask, which is how far is down? In 1982, at the end of the crashes that we saw, the end of the Iranian thing and all of that, the Dow Jones Industrial Average was valued at a level equivalent to today's value of 3,500. It was 75% lower than the current value today. We had dividend yields over 6%. We had a price-earnings ratio of 8. And that was sort of at the end of a recession that we haven't had yet. So if you take the Dow, if you take the economy down and then drop from there, there's a lot of potential downward room in the stock market. Will it get there? It hasn't gotten there since, so we don't know, but there's nothing that said that it can't happen again. And finally, Herbert Stein has a famous line that says, if something can't go on forever, it will stop. And we typically talk about 3% growth as a sort of norm for what our expectations are in the United States. And at 3% growth for 100 years, you end up with 16 times what you started with. Every quarter century you double, and at 50 years you double again. Does anybody here think that the Earth can support 16 of what we've got now? In China, they're doing 9 or 10 or 12% growth. At 9% growth, in 24 years, you get 8 times what you started with. Does anyone think that in a quarter century, even without peak oil, we can have 8 Shanghais and 8 Chinas on the planet? So this can't happen. And if something can't happen, it probably won't. But we don't get that, and I don't get it. I mean, it's still hard to grasp what this means, but I think that the changes that we're going to see are going to be quite profound, and that how we prepare for that, we can't plan for it, but we can prepare. There are no solutions, but there are responses, and I think that that's the approach that we can take. If anyone wants to read any more of what I wrote on this sort of thing, there's an article that was published in the May issue of Financial Planning Magazine, which is financial-planning.com. You can find it, and I have a few copies up here. But I do think that as a financial planning challenge, peak oil offers enormous opportunities, offers enormous challenges, and I wish you all well. Thank you.
Thank you, Dick. To wrap up today, we're going to turn to Jim Baldauf, who is, as you know, one of the founders of ASPO-USA and organizers of this conference, which their conferences grow in size each year. So I think they're onto something. Jim lives in Austin, and he's going to talk about the traditional oil and gas industry a little bit, which is he has some other ways one can invest in the oil industry. And then he'll talk a little bit too about his thoughts wrapping up the conference. Please welcome Jim Baldauf.
Thank you, Leslie, and thank you all for being here this morning and for attending the conference. It is really an honor for me to be seated at the same table with Mr. Charlie Maxwell and Leslie Haines, Jim, and Dick, because I am a simple oil drilling man. I try to, I'll tell you a little bit about it. What I'm going to try to do is talk about some unconventional investments in conventional oil and gas. There are at least three unconventional investments that I'll mention. A person can purchase ongoing production from oil and gas wells. A person can purchase royalty interest acreage in areas of drilling and development. And a person can purchase working interest in individual wells or drilling programs. All of these involve not so much paper and charts and graphs as layers of earth and well bores going down to oil reservoirs, as this illustration suggests. This is a cutaway illustration that shows a couple of formations here in Texas, and I happen to have some reprints of this that you're welcome to pick up as we leave, and it just kind of illustrates how a well bore goes down to a sandstone formation, or a horizontal well bore might intersect a horizontal formation, and you may find it interesting. We find in Central Texas that that we're having to drill twice as smart, twice as deep, at double the cost to get half the production that we used to get just 10 or 15 years ago. We're watching oil depletion in action. In spite of this, we are sometimes able to achieve several goals for investors, such as cash flow generation. If you buy interest in royalty acreage or working interest in a well, the well is drilled, and if it's successful, you start getting a check in about 3 months, 2 or 3 months. And you get a check every month that the well produces. Now, the well will produce at a ever-decreasing rate, but some folks in the peak oil community feel that what it produces is going to increase in value. There are tax benefits to each of these three investment opportunities, and there's wealth preservation, many people feel, in the increase of the asset. First of all, you can buy ongoing production from oil and gas wells. There's a kind of a rough formula for purchasing this. You can figure the current production and carry it forward 24 to 36 months. The production will decline, but the value of the production may increase. And there's a favorable tax consideration. You get a 15% deduction on your share of a well's revenues, and this is called the oil depletion allowance, something that is near and dear to all Texans' hearts and to the investment community as well. Secondly, you can purchase royalty interest acreage in areas of drilling and development. The best way to get into the oil business is if your grandfather had a cattle ranch and they found oil and gas underneath it. You don't have to invest anything. You just let the oil companies drill and you get your share of it. Generally, a landowner will get about 25% of a well's or a series of wells' revenues. Some landowners don't want to wait until a well is drilled, and so they will sell their royalty interest to people who want to buy it. Now, a well may or may not get drilled, and it may or may not be a good producer, but if it is, you get your 25%, more or less, and you get a 15% deduction on the income that you receive. A third area of investment is to purchase working interest in individual wells or drilling programs. Small oil companies, operators, drillers, and exploration companies often sell interest in their wells to other small operators or to individuals. As a working interest owner, you'll share in the cost and in the rewards of a well. A considerable benefit of this approach is you get 100% deduction of the investment, whether it's a good well or a bad well. If you put $10 into an oil well, you get to write the entire amount off your income and thus have less taxable income. Furthermore, you get to write off 90% of it immediately, the year you make the investment. It's keyed to what are called intangible drilling costs, and this is a tax benefit that rewards you for taking the risk and the chance of getting into the oil business. The other 10% is also deductible, but it's keyed to tangible equipment, and you take a standard business depreciation on it. You also get a 15% deduction on the income that you make. A lot of people want to invest in oil because there have been published reports that we're running out. Now, there have been other published reports that this is all nonsense, that there's no shortage of oil, no peak in sight. And here's an ad that says, peak oil, there's no peak in sight. So you have to look at both sides of the argument. And it may be that there's no peak in sight because yet another study published indicates that there's going to be plenty of oil elsewhere. So I thank you for your attention. I want to say that in the course of the conference this week, an idea by one of our chief supporters was to create a more permanent financial footing for ASPO-USA. And what we're embarking on a development fund wherein we will raise maybe $150,000, $200,000 that will permit the organization to then launch a campaign to get foundation funding and other kinds of funding. Some people have already contributed to this account. If anyone would like to hear more about it, would like to consider giving, we have a bag on this chair right over here, and we would invite you to leave your business card if you would be open to a follow-up call from an ASPO person to explain the development program that we're launched on. So we'll invite you to leave your business card if you'd be interested in doing that. We've gotten some press this morning. I was tickled to see that Bloomberg called us a nonprofit think tank. We've never really thought of ourselves that way, but maybe we'll pick up on that, right? And again, I just want to thank you all for your attention this morning and for your participation in the conference. Thank you.